What I will be discussing in this video is the bank reconciliation. And the question here is, what brought about this topic? How did we end up preparing this reconciliation? You are a company, you went to a bank and opened an account with them. This means that they will be handling your cash, like some of it. Since you already have that account with the bank will furnish you with what we call the bank statement. And in this bank statement, you will be provided with the deposits and withdrawals you made with that bank. But the problem with that is, normally, there is a discrepancy between your records, meaning your books, against the one in the bank. So you will be reconciling. And of course, there are reasons for the difference. But I will not be mentioning it right away so that this won't be confusing. I will just discuss them when I am there. But what you need to remember in the discussion of bank reconciliation is that we are considering two point of views. The point of view of the company, let's say company A, and then the point of view of the bank. And since you already have an account with the bank, you will be using a new account title. It's not cash on hand anymore because you had your money deposited in a bank. So you will have another account title called cash in bank, like this. And then, on the side of the bank, since the bank was able to get the money, the bank debited cash, right? And then, since the money received by the bank will be paid by the bank soon, the bank will be getting an obligation. So in bank's books, it will set up a new account title. It's called, let's name it, Deposits from Company A. Deposits from Company A. This is a liability and this is an asset. You have to remember that. Following logic, these two should balance, right? What you place in the bank should be the obligation of the bank. That's logical. They should have the same balance. But because of reasons, which I will explain one by one later, they don't. Meaning, if you have 90,000 here, this may be 100,000. Because of the reasons I mentioned earlier. And the amount here, 90,000, which is taken from your cash in bank P account, is called the unadjusted balance in the books because we will be adjusting this one. And then, the amount you have in your bank, the 100,000 here, is also called the unadjusted balance but with the bank. And the amount here, 100,000, is taken from the bank statement. This is the last line in the bank statement because you will have the running balance of your deposits and withdrawals. So the amount that you will write in the unadjusted balance would be the final amount in that bank statement. Again, the unadjusted balance in the company's books taken from the cash in bank P account, while the unadjusted balance in the bank is taken from the bank statement. And then right after that, you will be writing the adjustments. And adjustments can be plus or minus. Same with the bank. And by the way, these are adjustments. It's more than one, okay? And then, after doing the adjustments, you will get the correct balance. Both case. Let's say this is 120,000. This is also 120,000. They should equal. Because after the adjustments with the book, everything should be correct already. After the adjustments with the bank, everything should be corrected already. In turn, they should equal in value after the adjustments. Again, after the unadjusted balance, you will be adding or subtracting your adjustments to get your correct balance. And the correct balance should equal. Now, I will talk about the adjustments here. And this is books. point of view of the company. And in books, like if you are reading your FABM books, this is called book reconciling items. And we have 3 for this one. We have the credit memo, we also have the debit memo, and then we have book errors. If you are given a credit memo, you will add it to the unadjusted balance of your book. And then if you are given a debit memo, you will deduct it from the unadjusted balance of your books. And then for book errors, it can be add or deduct. But the actual problem here is, what's the logic? That's the very question. So I'll start with credit memo. This is your record, and this is the bank. And of course, you have your deposits with the bank, right? And then, for this month, you earned interest. For the month of, let's say, March. Interest in March. Let's say it's 100. This interest will automatically be added in your bank records because the bank knows it. But the problem is, in March, you may not be informed of this yet because you will only learn of this once you receive your bank statement next month, April. So in March, you don't have any records of this. That's why whenever you encounter these things, and this is called a credit memo, by the way, you will be adding to your own records, to the books, because you were not able to record it. But the bank did, right? The bank has the record. You don't have. So, in your records, in the books, this one, you should add 100. That's why, whenever you encounter credit memo, you will be adding. But you have to remember that this particular transaction is not isolated to credit memo. Of course, there are other scenarios. Let me give you another one. Let's say you ask a loan from a bank. Let's say you ask for 5,000 pesos. At the end of March, your loan was approved. So you are given 5,000 by the bank. Loan proceeds. No? I will label this as loan proceeds. And since this is given by the bank, automatically, naka-record sa bank yan. What's the problem? You will only learn of this next month once you receive the bank statement. So, even if this was approved March, if you are not given a direct notice by the bank that your loan was approved, you will only learn of it come next month. And since you only learn of that next month, you don't have records with you. That's why you will be adding. And this is another credit memo. So I hope you're getting it. That the nature of credit memo is you were able to get something but was informed of that next month. So you will be adding it this month. Another example. What if you have a customer? Customer paid. But instead of paying to you directly, the customer decided to just deposit it in your bank account. And let's say the amount is 2,000. So in this case, the bank will record it because it's a direct deposit by the customer to the bank. But if you were not told by the same customer that he did pay in the bank, you will only learn of this information once you receive the bank statement next month. So in your records, it's still 0. But since that the payment happened this month, it should be recorded this month, right? So to adjust, you need to be adding again. Okay? And this is the reason why credit memos are added in your books to the unadjusted balance of the book. These credit memos. Okay? So these are example of credit memos. Number 1, interest from your investment. Next is loan proceeds. After your loan was approved, you get the money, and then whenever a customer paid to the bank instead of you. Problem is, you will be notified of these things next month, but they in fact happened this month. So they should be recorded this month. So they are called credit memos. Credit memos are added in the books. Now we go to debit memo. This one would include deductions naman. So again, you have your record, you, then you have the bank. What if the bank charged you for something? Like you ask for the printing of the check, so you are charged. I will just label it as bank service charge. And let's say it's 100. Automatically, this payment is deducted by the bank to your account. Let's say it's 100. What's the problem? You will only learn of this bank service charge once you receive the bank statement next month. And you have to remember, this charge was charged to you this month. And following accrual basis, this should be recorded this month. So, you will be deducting. That's why debit memos are deducted from the unadjusted balance of your books. So this is one example. Another example, what if, this is called NSF. NSF is no sufficient fund. And this is the story. Let me just complete this. Let's say you made a deposit with the bank, 1,000 pesos. It was cleared, 1,000. And then, later on, the bank discovered that the balance of the original issuer of the check is not sufficient to pay 1,000. So, the bank has to return the check. So, it will be removed in the bank's records. And you will only learn of this next month in the bank statement. So, in your record, this is nothing. And since the return of the NSF check happened this month, it should be recorded this month. That's why we should deduct here. And this is also called a debit memo. That's the story, ah. And let me just explain this in Filipino because it may not be clear. So, ang nangyari ganito, you are the company, nakuha mo yung cheque sa customer mo, 1,000. At ikaw ngayon, dineposit mo sa bank. Dinala mo sa bangko, 1,000. So, pareho kayong may 1,000 sa records. Tama. Pero, eventually, nalaman ng bangko na yung customer mo na nabigyan ng cheque sa'yo, wala palang balanse sa bangko niya. So, ano gagawin ng bangko? Ibabalik yung cheque. Diba? Kasi wala namang balanse. So, binawi niya yung 1,000 na plus. And, ikaw, may inform ka lang nito once you receive the bank statement. So, this month, hindi mo pa alam. Next month, malalaman mo na yung cheque pala na dineposit mo, tumalbog. Since this month, hindi mo alam na tumalbog siya, wala kang record nun. Pero dapat, naka-record sa'yo yun. That's why, kailangan mo magbawas this month. And yung ganong case is part of your debit memos. That's why it's deducted. Another example for debit memo is your interest expense. Because in taxation, you don't really have to take this seriously. Whenever you are receiving passive income, meaning you are getting income without doing anything, the government will charge you final tax. And this final tax is withholded right away, meaning taken from you right away. So, if you are expecting a 100 interest revenue from the bank, 20% of that will be taken from you actually and be paid by the bank to the government. And normally, you will only learn of this once you receive the bank statement. So, in the bank, automatically, this, actually, it's not interest expense. It's final tax. Sorry. It's final tax. And since the bank is withholding, automatically, it's deducted from you. and you will only learn of this next month. So right now, you don't have any record, but you should record it. So you should deduct 20. And this is also part of your debit memos. Just to recap, no, about the memos we mentioned, credit memos, you add it because the bank was able to add it, but you were not able. So you add it. For the debit memo, it's the opposite. The bank was able to deduct it, but you were not able to. So that's debit memo and credit memo. Hopefully it's clear, because what's more important in bank reconciliation is actually the logic, why we need to add or deduct. And then for the book errors, this one is easy. And this is the rule for errors. Whoever made the error should be the one to correct it. For example, this is you, this bank. You deposited 1,000. But you made an error. Instead of writing 1,000, you wrote 100. So who will adjust for this one? Of course, the one who committed the error. The company should add 900 more to balance. Again, the rule is whoever made the error should be the one to correct. And you have to remember that these are book reconciling items. These are errors in your books, in your own records. You should accompany it with an adjusting entry. How do we prepare adjusting entry for this one? You will be adding 100. So, debit, cash, credit, interest, income. Right? This is the adjustment, 100. So, it's added. How about the loan proceeds? Your loan was accepted. So, meaning, you got the money, cash. And since you got the money, you will also recognize your loans payable. How about customer collection? You were just informed that there is a collection from the customer. Of course, increase your cash again by 2,000 and then reduce your receivable from that customer. How about for this charge, bank service charge? Of course, that's payment. You are charged, your money was reduced. So you'll debit bank service charge. Consider this one as an expense. 100. Credit cash. 100. How about for NSF? This one. Actually, I should only be circling the book side. I should only be circling this part. So what's the entry for this one? Since the money of your customer is not good, you will again regain your receivable of 1,000, but you lose the cash because the company's account does not have any balance. How about for final tax? You are paying the tax. So you just write tax expense maybe. And then credit cash for, what's the amount? 20. How about for error? You missed 900. Debit, cash in bank, increase your cash in bank balance by 900 and decrease your cash on hand by 900. Again, you only do adjusting entries for book reconciling items. You don't do this with a bank unless you are the bank in the story. But normally, you are the company in the story, okay? So this will comprise your bank reconciling items. I hope it's clear. There is actually a technique. So I will just share it here. The technique for book reconciling items is BC. C stands for credit memo and D stands for debit memo. So this is plus, this is minus. That's a technique. B is the unadjusted book balance plus your credit memo minus your debit memo. But again, problems will not give you credit memo or debit memo straight. They will word it differently. Like this one, interest, loan proceeds, customer paid. You need to determine that, hey, this is credit memo. Hey, this is debit memo. That is how you answer the problems. That's book reconciling items. Now we jump to another. We jump to bank reconciling items. You will be given the bank statement and then adjust the amounts because there may be transactions that you know but was not recorded by the bank. Example, sir, later. So let's talk about now the bank reconciling items. We have three. Number one, we have deposit in transit. Deposit in transit. Number 2, outstanding check. And finally, we have your bank errors. Okay, so let's start with deposit and transit. This is you. This is the bank. So you made a deposit like the last day of the month. Let's say March 31, you made a deposit 1,000. So it's in your record. You sent someone to the bank to deposit. But unfortunately, your employee who should deposit the money was not able to reach the cut-off. Meaning, instead of that money being recorded this month, the bank will record it now next month. So in the bank, it's 0 because of the cut-off. You deposited it this month, yes. But since it was not able to reach the cut-off, it was not recorded in the bank's records. So, to adjust, the bank should add 1,000. And by the way, I forgot. Ano ba yan? Deposit and transit, this is added to the unadjusted balance of bank. This one is deducted from unadjusted balance of bank, while this one is add or deduct. Sorry, I forgot. Let me just go back to the story. You made a deposit last day of the month, so it's added in your T account, but your employee who should deposit that money was not able to reach the cut-off, so it was not recorded this month, but next month. Again, the corrected balance should equal, no? If this is 0, it's not equal, right? So what you will do is add these deposits that were not able to reach the cut-off. And this one is called deposit in transit. Ito, deposit in transit yan. That's why, whenever you are given deposit in transit, it should be added in the unadjusted balance of the bank. How about outstanding checks? So this is you. This is the bank. Ito nangyari. You paid your supplier with a check. So in your record, it's automatically deducted. Let's say it's 500. And it's March 1. So you paid March 1, but the supplier was not able to encash the money right away. Instead, the supplier encashed it, let's say on April 6. So that's next month already. So in the bank, it's not recorded. This is 0. But the intention is to have that recorded this month, right? So the bank should be adjusted by 500 to reflect your issuance of check. Hindi na reflect eh. So you have to deduct it in the bank records. And this one is called outstanding check. So again, if you are given a deposit in transit, these are deposits that you intend to deposit but was not able to get into the cut-off. They should be added in the unadjusted balance of the bank. While for the outstanding checks, these are checks that intend to be in cash but was not able to reach the cut-off, so they should be deducted in the unadjusted balance of the bank. How about for bank errors? Again, follow the logic earlier. Whoever made the error should be the one to correct it. And then let's say you deposited 100. Instead of recording 100, the bank recorded 1,000. So who made an error in this case? The bank. So the bank should adjust. Minus 900. And then next question, do we prepare entries for this one? No, because we are not the bank. We are the books. We are correcting our own records. We are correcting our cash in bank. This is bank records, okay? And then there is a technique for this one. While the technique for this one is BCD, the technique for this one is BDO. Why? You will remember that it's bank because BDO is a bank, right? So this one is added. This one is deducted. What's D? That's deposit in transit. What's O? Outstanding check. The technique for bank is BDO. The technique for the company is BCD. You will not get lost because BDO is a bank. So you know that BCD is a book. Now let me summarize now the discussion. How do we now prepare the bank reconciliation? First, you will prepare the heading. So the first line that you will write in the heading is your company name. So whatever company name that you have, I will just write company name. And then the statement that you are preparing, this is a bank reconciliation statement, bank recon statement. And then after that, write the date. Let's say March 31. medyo 20. And then you start with your bank. You get the balance per bank. This is the unadjusted balance I'm referring to earlier. And you will write the amount here. And then you will add, this is BDO, right? You will add deposit in transit. Let's say you have 2 here. We'll just add these 2. And then you add the total here. Then get the total. And then deduct your outstanding check. Let's say you have 3. This 1, this 2, this 3, here. To get your adjusted bank balance. This is bank. Now you do the books. Balance per books. Write the amount here. This is, by the way, the unadjusted. Then you will add your, this is BCD, right? Credit memo. And of course, you have things here. So you just add them. Let's say you have 2. Then write the total here. Get the total. And then deduct your BCD. So D is debit memo. Let's say you have, again, 2. 1, 2. To get your adjusted book balance. And again, you only do adjustments in your records. You will only make journal entries for this one and this one to update your cash balance. You will not be preparing entries for the bank reconciling items. And you have to remember that the amount for this one and the amount for this one should equal. Because both bank and books were able to get all the adjustments necessary. And that's it for the bank reconciliation. Hopefully this is clear, no? In the next video, I'll discuss general principles of taxation. So see you.